Good morning, traders. First week of the new year nearly done. Just got the NFP and Canadian jobs to get through, and then it's the weekend already. I can certainly do with the weekend. Feels like I've worked half a year already, but always happens this time of year. This first week can be a little bit of a wonky one, a little bit of a funny one, but that's what we're here for. So let's get into it. The PBOC, they've had enough of seeing their bond yield dropping, so they're going to temporarily halt purchases of government bonds from the market, trying to take some pressure off those falling yields there, going the complete opposite way to where we're seeing a lot of global yields at the moment, which are running much higher. China's Vice Minister Liao says we can expect more proactive fiscal policy in 2025 in terms of its strength, efficiency and timing. So we're all waiting for that to come through. Over in Japan, a bit of data coming up. We had some household spending numbers coming after those earnings numbers, wages numbers as well. Spending up 0.4% in November. So that's very positive. Less down on the year, coming in at minus 0.4% versus minus 0.6 expected. So a bit of data there. We've already started on the BOJ sources stories ahead of January's meeting. And this one is from our old mates at Bloomberg, saying that the BOJ is said to look at weighing whether to raise its inflation forecasts on rice and the yen, and also upgrading its core inflation views for fiscal year 2024 and 2025. He says officials are still carefully assessing the data ahead of the Jan meeting. The market's taken that to mean that there's a potential for a hike. And obviously we've seen that reflected in yen pairs after those headlines. But it's not been a massive move down in dollar yen or yen pairs in general. I think the market is perhaps still got it in the back of its mind what happened last month when we had a hell of a lot of sources pieces indicating a hike was coming, only to be shot down in flames by Mr. Ueda afterwards, and a far more cautious approach and tone taken from the BOJ. So it's not as if yen's ripping anywhere, but these sources pieces are going to get the yen moving. We'll see how those develop over the days ahead. A bit of data out of Europe, Norway. We've seen some inflation data coming out there, softer on the month for core inflation, down more than expected on the year-on-year core. Headline CPI coming in low as well, 2.2% was expected to go up. Month-on-month also coming in lower. So that's going to keep the Norges Bank eyeing up those rate cuts. We've also had some other little bits and pieces. France consumer spending up a little bit there, 0.3% beating expectations. Industrial production up a little bit as well. Spain industrial production coming in down 0.4% year on year. Italian retail sales for November looking a bit sucky as well, down 0.4%. So as usual, particularly on these monthly readings, all still knocking around the zero line. It's all been 0. This and 0. That. So no signs of any real growth green shoots there. Over in the UK, we've had this palaver going on with bond yields, as you may know, and urgent questions were put in Parliament. They were directed at Chancellor Reeves. She decided to duck out and go on a trip to China instead, leaving her junior in charge. So the UK Treasury Minister Jones was out answering questions, saying there is no need for any emergency intervention by finance ministers, and that bond market moves thus far have been orderly. So a complete brushing under the rug from the Treasury Department, and the bullshit coming out of the Labour government regarding these yields rising is pretty much astounding. I'm in a bit of a rant mood this morning on the back of that. They're claiming that the public should not worry about the ramp up in yields, some yields to, I think, 24-year highs. This is the same party that were spitting feathers when this happened in 2022 under Liz Truss. And now they're saying, oh, it was a big problem then, it's not a problem now. That's utter bullshit. But anyway, before I descend into a proper rant, let's move on to those other circus. The Bank of England. We had BOE's Breeden speaking yesterday afternoon as well. And on the money, well, let's start keeping it to the gilt market stuff. Again, a brush under the carpet. She's Deputy Governor of the FPC, which is the financial stability arm of the Bank of England, so is well placed to comment on that. It says we are monitoring developments in the gilt market, but gilt market moves have been orderly, so it's so far so good. So again, nothing to see here as far as she's concerned. On the monetary policy front, though, Breeden was a hold voter at the last MPC meeting. She voted to keep rates unchanged. But a comment yesterday said that recent evidence further supports the case to withdraw policy restrictiveness, and that we should expect a continued removal of policy restrictiveness gradually over time. So that's potentially putting her into the cut column in terms of the next MPC meeting. She deems that enough has been done in that recent evidence to vote for a cut. So we could be getting another shift over the line from hold to cut based on the current or the last vote patterns. There was a 6-3 vote to leave rates unchanged. Maybe if she's the only one to move, if she does move, it will go a 5-4 vote, which will put us right on the brink of another cut. Over in the data, and the data yesterday, not an awful lot because the US was closed pretty much. We had Challenger layoffs, something I've been keeping an eye on, coming in at 38, just under 39,000, which was down from the just under 58,000 we saw last month. These numbers had been getting a little bit on the higher side over the last few months, but it was less so in December. So still seeing plenty of job cuts coming through, but nothing that's going to shake any trees at the moment regarding the jobs market. Fed's Collins says the current outlook calls for a gradual patient approach to cuts. Fed's Harker says that we're still on a rate cut path and future moves will be driven by the data, and that it's appropriate to take a bit of a pause amid some uncertainty. It says the Fed can stay where it is for a little bit and let the data play out. Fed's Barking thinks term premium is moving long rates, not inflation. So that's investors basically wanting a little bit of premium on top to hold government bonds. Hence some of the yield rises down to that. Just investors looking for a bit more insurance, i.e. higher rates to hold government bonds, just in an environment, usually in an environment where rates are or can be a little bit choppy in terms of interest rates, whether they going down fast, holding, or whatever. So Barkin thinks it's those term premium, not inflation forecasts or estimates that are keeping yields higher. Fed's Schmid favours gradual cuts if the data improves. Rates may be very close to the longer run neutral rate. It says the Fed is not likely to reach its 2% inflation target until 2026. That'll be a big old hold if they wait for that. Fed's Bowman prefers a cautious and gradual approach on rates. Says she could have supported a no move at the December meeting. Says the policy may not be as restrictive as others think. Canadian PM Trudeau was banging on about Trump. Says that Trump is talking about annexing Canada as a distraction tactic. Says the man who's talking about this as a distraction tactic from his own bad news of getting booted out as PM of Canada and his party going to a general election. Anyway, distraction by distraction. Mr. Trump apparently is going to be meeting with Putin. A meeting is going to be arranged sometime after he takes the seat in 20th of January. So that's going to be a big something for risk to keep an eye on what happens there if we do get this meeting. A lot is hinging on this 20th date when Trump takes the hot seat, and he's going to solve all wars and sort out Ukraine, Russia, and all the rest of it. So it's going to be a big old period for markets when that happens. That's about it on the main headline front. Nothing much else going on yesterday because, as I said, the holiday. Let me put the link in there. Someone's asking for the NFP compo link. Himashu, I don't know if I want to give you the link, mate. You keep winning it. I think you've won it quite a few times recently. Anyway, here's the NFP compo link. Whack that in there. If you haven't already entered, last chance to do so. Right, let's have a look what's coming up today and talk through the jobs numbers. And we can go over the usual what to look for, how to trade it, how to view it, how to understand it. So 164,000 is the call for non-farm payrolls. That's what we're looking at. Again, my view is anything 100k, 200k is sort of pretty much there or thereabouts. Nothing that's going to shake markets too much. If we're outside of that sort of range, then obviously on the low side, the more weaker the dollar may go. On the upside, the stronger it may get, the higher yields may go, etc. So that's how we read that first number. I think the more important number right now, and this importance can switch depending on what we're looking at, whether it's wages and inflation or whether it's just unemployment in itself. So this unemployment rate number is going to be the most important, I think. It's probably going to trump the main number if there's no big shocks from the main number. So obviously unemployment going up is going to be the bad news. That's going to pretty much torpedo a lot of pause expectations depending on where that goes. A 4.3 will be a bit of a weak number. Anything higher than that, 4.4, even maybe 4.5, will be a bit of a shock to the market, and you're going to see a big unwind of some of those pause expectations. As I said, we'll probably see yields coming down quite significantly and the dollar following as well. Of course, if it goes the other way and we get unemployment, 4.1, 4.0, that's just going to ramp up pause bets and that's going to keep yields firm and the dollar firm. Whether there's enough to send things on another leg higher, I'm not sure. I think yields are starting to get a bit stretched up here, given that the Fed still want rates down at some point. So I think maybe the upside becomes a bit limited. I won't rule out a spike up on strong data, but it may be something that just runs into a bit of a reversal, maybe a bit of profit taking later on in the day. But who knows? We shall see. Trade what you see, not what you think. Obviously, when you're looking at the unemployment rate, you need to factor in the participation rate. If the participation rate goes down, it can cause the unemployment rate to go down. Okay, vice versa. Participation rate goes up, it can cause the unemployment rate to go up. So you need to watch these two numbers together. If that goes down and that goes up, that's a bad move. That is a proper bad move because it means people are coming out and that goes up significantly, then that's a double whammy. A really good number is that going up and that coming down, the unemployment rate coming down. So part rate up, unemployment rate down. That's a really good number. So you have to factor that in, okay? If we get a little rise in this one and a little rise in that, then you can probably blame the unemployment rise on the participation rate, okay? But if that goes up and that comes down, then that's a double negative sort of thing. Anyway, wages, keep an eye on those as well. Average hourly earnings year on year, 4%. I know a lot of people look at this monthly number. This monthly number can go up, it can go down, it can go up, it can go down. I keep an eye on this year on year number because that tells you how things are running on a more broader basis. And as you can see, it's been pretty steady around this 4% level for quite some time. Okay, so that's, if you see a big move up here, if we get up to 4.3 something like that percent in wages year on year, again, that's going to keep the Fed in pause mode and push those expectations that way. I don't think the market's really going to pay attention unless we're getting down below 3%. But if we get a 3.5% number here, then again the market might take that as a sign that that wages are coming down. That will take out some inflationary pressure as well. So it's headline, unemployment rate with a part rate, and then wages. That's what you need to know. Read those as quick as you can, then you get a good idea how to trade it. But as I say, the market will be focusing on the unemployment rate. Okay, so if that comes down to 4%, and even if we've got a 50k non-farm payrolls, the market will trade on the unemployment rate. Okay, so that's why you need to know where the data is. Ali, seriously, mate, I've just posted it. The post above yours, the competition link, mate. We've also got Canadian jobs as well. So if you're trading the loonie, dollar CAD, anything to do with CAD, then you need to keep an eye on this one as well. We're expecting a healthy 25k boost to jobs there from a prior 50k. Now this number is another one that's been pretty volatile over the last few months. We've had high ones, we've had low ones, but the last 4 jobs prints have all been positive numbers. Okay, irrespective of whether it's a miss of expectations or not, they've all been positive numbers. Okay, so we're coming into the latter part of the year. We'll have to see if there was some late year wobbles for that. So positive numbers expected there. Again, look at the revolving door, whether it's full-time or part-time. That tells you whether, a stronger jobs market wants to see more full-time employment than part-time employment. Same thing with the unemployment rate. That has been ticking up even while we've been getting those positive jobs numbers. As you can see, bit of an upward trajectory that's been going on for quite some time. Quite shallow, but the direction is pretty clear anyway. So again, the market is probably more going to trade Bank of Canada possibilities on the back of the unemployment rate than it will on the jobs rate. Okay, and again, participation rate here is important as well. After all that, we get the Michigan flash numbers for January. Keep an eye, as usual, on the inflation expectations, 1 year, 5 year, as well as how the consumer is thinking overall coming into the latter part of the year into the new year as well. Any big wobbles there will obviously influence Fed expectations. Right, so that should have you covered for the data. If you've got any questions about how to trade this data, anything like that, how to look at it, other than what I've already explained, please pop that in the Zoom chat and I'll cover that to the best of my ability as well. Right, let's get rid of some of that crap first. Right, Ali, my old mucker, what are you up to today? Still holding shorts, Aussie dollar. Yep, that's looking a bit better this morning. Holding yesterday's longs in Euro Swissy. What's Euro Swissy doing? 94.15, so you're still there or thereabouts. Your longs on gold at 72. Let's start on gold for once. So it's still grinding up. It's in a real old grind, taking quite some time just to grind up to these levels. We have got above this 26.70. It is trying to build a little bit of a base now. So as I said yesterday, you want to wait for either a trader break and potentially then wait for a confirmation. So we had a break yesterday. It didn't last. We're back under. Then we got a secondary move and now it's starting to hold. So trading off of that level has proved okay for now. Got a few bucks in the bin on the back of that one. We can't yet get up to this 26.85. You can probably extend that to 90s, something like that, take into account these little price action moves here. But it's still going the same way. The only thing I'd say is when you see a slow grinding price move, okay, it doesn't take much to knock it off its perch. It doesn't scream, strong sentiment. It does in the short term, but in the longer term, are we going to see anything that breaks us out of these ranges here up to 27, 20s, 30s, that sort of range? So it's moving. You can make money on it. As I said yesterday, you just got to be a bit careful. If it's a big number miss or whatever, and gold decides it wants to come off, it's probably going to go down twice as quickly as it's gone up in all this period here. So just be a bit careful with it. I'm not bullish, I'm not bearish on it, right here in the middle. So Ali, you're in a good one, mate. You know where your levels are. You're putting a break even on that one. Good stuff, mate. And you're messing around in euro dollar as well, short at 102.95. Euro dollar still looks weak, okay, but we're holding this level at the moment, 102.75.80. Okay, this is the step up from this low quite clearly, because we've had several tries at this level and we're not getting through it. The only thing I would say is that the bounces are very weak. Yesterday, okay, bit holiday related, we were limited to 103.20s. Okay, so these bounces off this level are not really looking any good. If we get strong data, then we're probably going to, US data, we're probably going to be having a look down towards these lows. This level probably won't stand in the way and we'll be looking much lower. On the other side, if we get poor data and we see a rally, it's got to do an awful lot of work. You know, we've got this zone here, 103.40s to 60s. It's a bit of a traffic area. It's a zone that does go back quite some way. If I can find it, goes back all the way into 2022 through 2023. We've had places where this has been a bit of a traffic area, hence why I had it highlighted on my chart. And that's why you can see we've been messing around here. When we came down previously, held as support, 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 and then we got the break, and then it's resistance and so on and so forth. So this is, again, in the grand scheme of things, getting back above here will just be a small step. Nothing looks like it will be changing unless we get above 104.50. Okay, and even then, all that will look to change is just this secondary phase, okay, from December. Doesn't change anything here. The move from 109s doesn't change anything here. The move from 112s. Okay, all small stuff down here. This is still very, very bearish, even if we're holding this level at the moment. So Ali, you're short. Can't say you're short at 102.95. You want to take profit at 102.98. That doesn't add up, mate. Where's your take profit? 101.98 maybe. Let me know. Anyway, yeah. In terms of the euro dollar, it's stopped going down, but it's still looking very bearish. So if this level holds over strong US data, then that might give you something. And if you're short, Ali, that's what you want to be careful of. If you see a move down here over strong US data and it holds again, then the likelihood is that we might be finding a bit more bottom. That will give traders something to latch onto if they want to go long. Aussie dollar, I'm still in a little bit of this after my nab yesterday. Similar story to euro dollar. We've had a bounce, not a big bounce, and it can't even hold into the 62. So still looking very weak at the moment. I have got my stop just below this level, but I'm thinking of yanking that up a bit, maybe even just getting out the trade, particularly ahead of the data later on. This was just a quick scalp trade. I'm not looking to sit in it for hours and weeks, and I'm probably not going to risk it over the NFP either. So I'll probably bolt out of that one. Going back to dollar yen. So the BOJ move took us down to this level again, 101.57, whatever you want to call it, 55.60. Okay, and we've had a bounce from there. So this support is showing up. And again, I don't know if my mate Ekisola is here today. My stop on my longs was under that level. Okay, that's the reason I had it under the level, because I saw this as a level. So I wasn't going to put my stop on the level. I'll stick my stop underneath it. So I'm still in the trade for now. Again, I might think about what I want to do with this one going into the data, considering again it was just a little bit of a headline trade a couple of days ago. So anyway, we're still struggling up here, 158, 40, 50s. We can't get through. We don't know whether to hold around above or below 158s. But my view remains that it is still at the moment a buy the dip pair to look at. We keep coming back from the dips pretty quickly. The dips are looking pretty shallow. We're just struggling a bit to get on the upside. I don't expect this to do much over the data. What I would wonder, though, is given that BOJ headline, maybe the market will want to just see the NFP data before it starts swinging around to trade in the Bank of Japan. So again, if the data is good but not rockets, maybe we see a bit of easing coming off in the dollar, maybe even in yields as well. So just keep an eye on this one. We may have bounced after that BOJ story, but it doesn't mean we finished trading it. And if we do get a break up, I want to see 158.50 holding the support. If you get that move, then we're potentially off on another phase. If we can't, if we maybe have a little blow through to, I don't know, 158, 70, 80, and then not long after we're back below 158.40, that wouldn't be a strong bullish signal. And maybe we see a bit of a steeper pullback. Likely we just see a bit more sideways action going on for this one. So yeah, I'm just getting to the point. I maybe have a bullish bias for the dollar, bullish bias for this pair, but I'm getting a bit wary how high we've come, how far we've come, and how much more it can do based on the data it's going to get. We know the market is already pretty much fully pricing a pause from the Fed, so it's not got much more to price in terms of that, and thus how much this can go higher. Himashu, yes, I'm still in my Aussie Kiwi short, and it's still not looking the greatest at the moment. It does look, as I said earlier this week, it does look like we're potentially going to get a test to this 1090s, 111 area. If this pattern continues, then we're going to be breaking it, and we may be looking to head up back towards these highs. I'm still in it. I've seen a few more bank notes and analysts coming round, pulling forward their RBA rate cut calls to next month. They all were around February, around Q3, Q2, Q3 last year. Then they got pushed out to May and further in the last couple of months of last year. Now there's a few people pulling them back to February. It's all going to come down to the data. It's not gone exactly the way I wanted it to. I thought we were on our way when I was shorting it here, and I'm thankful for taking profits down to here as well. But I don't know. As far as the RBA trade goes, they need to say something now. If they put a cut on the table at their next meeting, then we're probably going to start to see this one grinding a bit lower, maybe going a bit of a sell the rally as opposed to a buy the dip it's been at the moment. But as I say, I've got a half decent average, so I'm not really bothered about it. I've taken a good chunk of profits off, added back, sliced, that sort of thing. So my risk is much lower. I'm happy to stay on this. If we're busting through this level, then I'll probably have a bit of a reassessment. I might even do so if we get over 111. I'll see what's changed in that one. The reg, still looking at the old pound CAD. Let's have a look at that one. So it's stopped going down for the moment. So it hasn't quite got down to that trend line down there, the support trend line, bottom of this, maybe you can call it a channel. So it's a little bit in the middle here. It all depends on whether we're going to see any further follow through in yields, the reg. From the CAD side, at least, and this is probably one of the pairs that might be least affected by the moves in oil, because sometimes the pound can be a bit of a commodity currency as well, obviously, because we're involved in oil markets as well. But oil as well has been breaking or trying to break up a little bit as well. I don't know why we're seeing oil boosting up. It may just be I don't know, a bit of the weather, cold spells happening all over the place. So from the fuel side of things. But for now, you know, this support down here proved very solid again in December, and now we're seeing a move to the upside. I don't think this one is going to be shooting all the way up to $90 or anything like that, unless we're seeing a big change in the data. Obviously, got the shenanigans going on with OPEC and whatnot, but whether this is supporting the CAD at the moment remains to be seen. It doesn't look like it's doing it in your pound CAD, Derej. Doesn't seem like it's doing it in dollar CAD either, which we'll have a look at in a moment. So, yeah, this is more what's going on in the quid than what's going on in the CAD at the moment. But I can't rule out another move to the downside. But as I say, if things steady down in the UK, then maybe we're going to start heading a bit higher again. So I might as well look at dollar CAD, seeing as it's jobs data going on as well. So as you can see, we're going up, i.e. the Canadian dollar weakening, and that's even while oil is strengthening. So there's a bit of it's been a disengagement with the oil correlation at the moment for dollar CAD, at least. Bigger things going on. Unless you see a real big move, unless we're getting up to $80 in oil, then we're probably not going to see the correlation getting a bit tighter between oil and CAD. Still, dollar CAD pretty much bang in the middle of the range. So this will be an interesting one as well, because we've got the US jobs and the Canadian jobs. So if Canadian jobs are crap, US jobs are good, then obviously that'll have a double wind for moving higher. Obviously, the opposite is true. If US jobs are crap and Canadian jobs are good, that's a double wind for a move lower. If one's good, one's bad, the US one will slightly outweigh the Canadian one, but all in all, depending on the variation, we probably just sit in the middle. So again, if you're trading this one, trade it the same way. Trade the range. If it holds, trade the breaks, or look to trade the breaks. If it doesn't, you can try and catch some breaks like this or wait for confirmation. We didn't get any real confirmation that we had a break here. So, you know, a secondary attempt at going short after we had a move wouldn't have worked. So that's why I like to wait for confirmation sometimes on breaks. You know, sometimes you can catch that sort of move. If you're getting a tight stop, you know, sell stop, then maybe you can take, you know, 30, 40, 50 pips out of it. Or you wait and see if you get the level resisting. We didn't get it resisting. It poked above, and then the next time we came up, it went straight through and then went straight as support after. So that was not a price action move you want to get short on. Okay, if it held there, held for a few minutes, then a couple of hours, then that's your signal to go short. So for this one, if we get good US data and we can't break through there, that will solidify that top. That will give you something to potentially go short against. Maybe you're going to move down back to the range edge. Same on the downside. Bad US data, can't get through support. That's your signal to maybe give longs a go if that's what you wish. But otherwise, here in the middle, not doing anything at the moment. So exactly, Ali, if you're looking for levels to short dollar CAD, there's your perfect level. Wait for the data, see what happens. You know, and again, it doesn't even have to hold there. If we get strong data, bad Canadian data, strong US data, you might get a blow through up to 145. If that doesn't last though, if it's just a spike move and then, you know, within minutes we're back below here, that is potentially a signal to try a short. Okay, if it's back below and holding below again, then that's just going to be a bit of a fake out on the data. But otherwise, you know, there's your level at the moment, 144, 60, 65, 70. That's your resistance point to look at. What else shall we look at today? Not a lot going on in the old dollar China, still hovering up near these highs. I haven't added back to my position up here the stuff that I was slicing on Monday down to here. I'm not keen to add up here just based on the price action. Still looking fairly bullish on here. Still potentially think there's a possibility we're going to see a break. And I have to be objective when I'm trading. I can't just be in a position and talk my book and try and G it on like it's my last fiver at the last horse race of the day. I have to think about what the risks are to my trade. So I think there is a strong risk that we break up. I'm happy to stay short while the level holds, but I'm going to refrain from adding to the position at the moment. And I'm still running some buy stops up through 738 if it does break. But again, this one probably going to have a bit of a move over the data as well. If we get another test and hold up there, maybe I'll add a little bit back to the position. But yeah, not overly keen on this one. Going to have a look at dollar MEX as well, because that's had obviously a bit of movement over what's going on with Trump, and that need to do a bit of redrawing on the old fibs, I think. But again, this one still looking bullish. Still happy to make new highs. Okay, that's may have held it, may have just been a quick move, but the fact we did make a high above there is a bit significant because it just cracks the egg a bit. So again, if the dollar's going to keep branching on, then this one might be busting up again following those yields. And of course, there's one eye on the bun fight to come between Trump and Sheinbaum when he gets in office. She's been doing a bit of trolling recently, saying when Trump was saying that the Gulf of Mexico should be renamed the Gulf of America, she pointed out that in ye old ancient days, America used to be called Mexico or part of Mexico and all that sort of stuff. So she's been doing a bit of trolling of Mr. Trump as well. All good fun, I'm sure. So this one is, again, another contender. Strong US data. If we go up and tap that level, but it holds this time, then again, you've got the potential for a bit more of a solid top and a bit of range trading going on. Right, anything else for anything else, boys and girls? Let me know forthwith, and we'll have a look at it. Yeah, Derez, she's buggered off to China to probably go and kiss ass over there and see what she can do with that. Quick one, Euro Sterling. And as I said yesterday, I can't remember if it was here in the chat room, we've had this move up, this strong move up. It's not for turning just yet, but we have had a little bit of a pullback around this support area, 83, 65, 70. Okay, that's where I expected if we were going to pull back, and if it was going to keep this rally going, that's the area it has it. And so that's exactly what we've seen, a little bit of a knockback, but we're back above now. Now we're just tinkering around this 83, 80, 85 level, which is just a short-term one, just one of those ones where we've done a bit of price action around here previously. We still have the possibility of breaking higher in this one. But again, as this was driven by what was going on in UK yields and whatever, if that has eased off a bit, which it has today, there's no real reason for this to keep shooting higher. If yields keep creeping higher, then this will probably start creeping higher as well as the pound follows. And we'll look at cable, which once again is looking a lot like some of the other pairs as well. 123, 23.10 is the area at the moment. We just can't get through there and hold through there. The stepstone off of this low has decided to come in at 122.60s. Okay, so again, that's your NFP level. If we're breaking below that, then we're potentially on for another test of those lows there. If you get a hold down here, then that might potentially be a good long opportunity. If the data's strong and we hold that level again, then we're probably going to see a bit of a bounce. Whether it's enough to get through 123 is another thing, but then there's at least maybe some decent pips in there if that happens. But otherwise, it's still very, very weak, still part of the wider trend that's ongoing. Nothing changes here unless we're getting up above 124.50. So there's a lot of little levels to mess around with, but for the more longer term picture, nothing until we're above 124.50, more so 125. Okay, and that's a long way away from here. So there's still every chance we're going to look lower, and 121 to 120 is my big area. Ali's asking, what trade do I ride? if I take a position with a stop loss and take profit target now, you're in profit. Not sure what you're saying, Ali. Depending on what if I'm trading long-term trades, then I'm adding positions all over the place, you know, potentially many pips apart. If I'm just doing short-term trading and I want to hold the slice and dice, I don't take different positions. I'm sorry if I'm not understanding you properly. If take something like Aussie Kiwi, depends on what I want to do. So I was getting short in this rally up here, all the way up here, and I was taking a lot of profit down here, and I was adding a little bit on rallies and taking profit all the way down. So I then have a core position, okay, which you can work off an average or you can work the bits individually, depends on what you want to do. And it's just the same thing. I'll look to stay in a trade. I'll look to take profit when it's there. I don't have profit targets, okay? I know you have profit targets. I don't have profit targets. I have places where I will take profit if we get there, but I won't get in a trade like short Aussie Kiwi and say my profit target is 107 or whatever. My idea is to see a move for this one down to the big old magnet at 108. This is let's go into a wider one. This 108 is a level that we come back to time and time and time again. Look, this is just going back to 2016. We have moves below, we have moves above. Okay, this has come through everything. Okay, COVID, the end of the GFC, banking crisis, whatever, Fed, RBA moves, inflation, rates, blah, 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 blah. Okay, we've come back to this 108 level time and time again. We may have strayed away for a bit. We stayed away for pretty much the best part of a year, 6 months in 2022. Okay, so it's not something that happens every 5 minutes, but when you get a trend like this that just happens and 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 happens, no matter what's going on in the world, then for me that's a reason to trade it. And the reason I've traded it is a bit on the back of the central banks, that the RBA will be forced to cut quicker than they expect and further than they expect. So any rallies in this one, I'm trading against that, and I'm happy to try it because that's my view. So this 108 isn't a profit target, but it's somewhere I will be looking for the price to come back to. And on the way down there, I'm going to be taking profits anyway. What happens when we get down here is another question. Okay, I will probably, if I'm still in the trade, take a big chunk off down here, just in case it bounces from there, as it has done previous times. But if it keeps on going, fine, then I'll bring my stops down and I'll see where it wants to go. But I won't have a profit target under here. It will be wherever it wants to go and how long I can stay in the trade for. So I don't have profit targets, mate. I just stay on it. I don't want to give up a winning trade. It doesn't hurt, and things like that doesn't hurt my risk reward. You say if riding a position is not going well and the market went back, does it hurt your risk reward? It doesn't hurt my risk reward if I've already been taking profit. Okay, because when I set out with a trade, I knew how much I wanted to risk, and so that was my maximum risk. Okay, and all the slicing and dicing that I've done, unless I've still got the same size position, but it still doesn't matter because I've got profit on the table. So even if I get stopped out on the same size position, I've already banked money. So my risk, the money I'll lose after that, is still less than what it was when I started out. Okay, so my risk reward is already screwed the right way because I've already got money in the bank. Okay, so that's the way you've got to look at it. Okay, getting my risk to zero as fast as possible doesn't mean I'll get it to zero all the time, but it means if I was risking $1,000 on this trade, okay, the profit I've taken, let's say I made $300-400 already. Okay, I've still got the same size position, but I've already reduced my risk, you know, by 30% or whatever. All right, so even if I get stopped out, I'm going to lose the same amount of money, but I've already made a bit of money in the first instance. If you get my drift, so I'm just going to give it back. Okay, so it's all about shifting your risk. Okay, getting it as low and low as possible. If you can get it to zero, if you can get it into positive territory, then you're never going to lose money trading. That's the way you've got to look at it. Right, that's that. Thank you, everybody, for coming to the Flow Show as always. K-Man's actually going to be back on Monday, so we'll get to hear his latest thoughts. Thank you for supporting us here at the Flow Show. Don't forget to give us a little retweet on the old Twitter when you see the show go out, so we can get plenty more people in and watching. And thank you for all your questions and interactions and everything. Have a great day's trading. Have a great weekend, and we'll see you all next week.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.